Today I would like to analyze BYD. It's one of the biggest electric vehicle producer in the world. We can see here some of the products. They not only make electric vehicles, they also do other products, as we can see here: truck, van, forklifts, bus, and even rail transit. And if we take a look at the stock price, we can see we are up around 700% in the last 5 years, and we have a great performance. And we're going to take a look at the financials to find out if this company is still undervalued. BYD has a market cap of around 140 billion US dollar, which makes it the third biggest electric vehicle company by the market cap, as we can see behind Xiaomi and Tesla. But if we're talking about how many cars this company is selling, it's the biggest company in the world. It's overtook Tesla already in 2022 and maintained its position in the ranking through 2024. So it's the biggest electric vehicle company in the world by selling amounts. We also have a dividend of around 0.94%, which they also increased significantly in 2024, and probably they will increase this dividend in the future as well if the company keeps going in the right direction. The first thing we're looking for is revenue growth in the last 5 years, because we want to invest in a growing business and not a declining business. So we can see here in 2019 the revenue was around 127 billion Chinese yuan. Then we had the 22% increase in 2020, then the 38% increase, then the 96% increase, and then again 42% increase, and then in 2024 the 17% increase. So overall this is really incredible, especially in 2022 we nearly doubled the revenue. So this company has a great revenue growth, so it's a check here. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2019, the free cash flow was around 6 billion Chinese yuan in the negative. Then we had the strong year in 2020 with 33 billion in the positive. Then we had the 16% decline in 2021. Then we had the strong increase around 54% in 2022, and then the 10% increase, and then we had the decline again. I think this number is wrong. We had the free cash flow around 37 billion Chinese yuan in 2024. So overall it's looking good. We have a check here because we made the free cash flow positive and we could growing it as well. What I also think is interesting, the operating cash flow increased way higher than the free cash flow. We can see it was already positive in 2019, and we had the way stronger increase over the years. The reason for that is we have the capital expenditures, and they were especially high in 2022 with 97 billion Chinese yuan, and then also in 2023 around 122 billion Chinese yuan. Now it's decreasing. So what does it mean? I think this company investing huge in the future in new factories and other stuff. So this is a good thing. I think it will help the free cash flow increase in the future. The next thing we're looking for is free cash flow yield over 4%. This can also tell us about the valuation of this company. If it's under 4%, it can indicate an undervaluation. So what we're going to do now is we're going to take the free cash flow in 2024, around 37 billion. Then we're going to divide it with the current market cap of 1,013 billion Chinese yuan. And then we're going to get the free cash flow yield. So the number we get is around 3.7%, which I think is a great number. Of course, it's under 4%, so it's not a check here. But overall, if we can think that this company can increase the free cash flow in the future, and I think this company can do that, especially because it's a growing market and they are very strong players in this market. So overall, I think it's a good number. The next thing I'm looking for is debt to free cash flow ratio under 5. So this means the company can pay back the debt with the free cash flow in under 5 years. So very important number as well, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So what we're going to do now is we're going to take the long-term debt, and then we're going to add the short-term debt as well. So the long-term debt is around 9.7 billion. Then we're going to add the short-term debt as well. We can see here around 20.5. And then we're going to divide it with the current free cash flow, around 37.5. And then we're going to get the debt to free cash flow ratio. So the number we get is around 0.8. So it means a little bit under 1 year we can pay back the debt with the free cash flow. This is a very good number. Is a check here. Then we also can take a look on how much money this company has in the bank. We can see here around 91 billion Chinese yuan. So we can already pay back the debt with this money and invest in the business. So it's a good amount as well. We really like to see that. The next thing we're looking for is the enterprise value to free cash flow ratio under 25. So this can also indicate if the company is undervalued. So what we're going to do now, we're going to get the enterprise value. So we're going to take the market cap around 1013 billion Chinese yuan. Then we're going to add the debt that we had. This debt was around 30 billion. Then we're going to take minus the cash on hand. So this is around 91 billion. So this number we're going to divide with the current free cash flow around 37.5. So then we're going to get the enterprise value to free cash flow ratio. So I'm going to calculate this. So the number we get for the enterprise value is around 952 billion Chinese yuan. And then we're going to divide it with the free cash flow. So the number we get is around 25.38. So this means it's close to 25. So this can indicate that the company is fair valued, I would say. I would still say it's not a check here because it's a little bit over 25. But overall, it's not indication that the company is extremely overvalued. So probably this company is fair valued right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. This is something we like to see, especially if we think the company is undervalued. So we're going to take a look now and we can see overall the shares outstanding did increase in the last 5 years. This means there are more shares outstanding and this company gets the money from the stock market. So this is overall something we don't like to see, but if it's still a young company, it's okay because the company can invest in the future and can get more free cash flow with the invested money. So I think it's not a problem here. I would like to give my conclusion about this company. So let's start with the positive. So they had a strong revenue growth in the last 5 years. They also had a strong free cash flow growth. And they have a good balance sheet as well, which means low amount of debt and good amount of cash on hand. The free cash flow yield around 3.7% is not extremely high, so it's not indication for extreme undervaluation. And also the EV to free cash flow ratio around 25 is also not indicates that this company is extremely undervalued. But if we can see the free cash flow grow in the future, this can be a good buy right now, in my opinion. We also need to mention that we are up over 91% in 1 year. So this is a significant increase. And we can also see in 2022, we had a strong performance as well. But then we also had a strong decrease for some time, around 42% down. So overall, I think if you believe in this company long term, it makes sense to invest a smaller amount, maybe every month.